Support provided by Walters, Papillon, Thomas Cullins, LLC, specializing in business litigation and personal injury cases for over 40 years.
Well, it is a pleasure to speak with you here today as a fellow Rotarian, as a fellow Louisianian, and from the Federal Reserve Bank of New Orleans. We are the consolation prize, I like to start these speeches out with, to the Federal Reserve Bank of Atlanta in the system. So the Federal Reserve Bank system, if you don't know, has 12 districts across this country. So 105 years ago, when we were established, the country was divided geographically to bring information from all of the regions of the country to Washington, where our Board of Governors was, or is today. In that concept is a corporate office in each of those 12 areas. And of course, there was a battle between Atlanta and New Orleans for where that headquarters would be. Obviously, Atlanta won that battle, but New Orleans actually started the branch system of the Federal Reserve Bank. There was not a branch system envisioned prior to that. So today in the 6th District, we are proud to have 5 branches across our geography, and each of those branches has a board of directors. So the other thing I would like to do today is recognize some people in the room that you might recognize who are members of this Rotary. Both Terry Sterling and Terry Fontenot served as board of directors for us at the Federal Reserve Bank branch in New Orleans, and Terry Fontenot actually served also on the board of directors for that competitor Atlanta piece of our responsibilities. They also sign my paycheck. So anyway, what I'm here to talk to you about today is what does those list of words that Terry read to you mean with what it is I have responsibility for today. So as a regional executive in New Orleans, I'm responsible for bringing monetary policy information to our president, which means I'm out in the community across South Louisiana, South Mississippi, South Alabama, and the Panhandle of Florida through Apalachicola, talking to business leaders, community leaders about how you're experiencing the economy. How's demand? How's business? Do you have the ability to increase prices? Are you able to find employees? And are those employees skilled, or the few of the things that we talk about with individuals? And I'm going to spend my time here today with you talking with you and hopefully giving you some insight into how we think about the economy and ultimately how our president, that we provide all of that information to, what he does with that as he thinks about whether interest rates, as Terry indicated, should go up or down. So we have a dual mandate from Congress. In the act that set up the Federal Reserve Bank, in addition to saying we needed 12 different corporate headquarters of our system, we were given some very specific assignments. So we are responsible for price stability and full employment. So a way that the Federal Open Market Committee thinks about that is we're responsible for establishing an environment, an economy for this country that allows businesses to grow at a pace that is reasonable, stable, price stable, and allows for full employment. So our president sits on that Federal Open Market Committee. You'll recognize some of the past chairs as Greenspan, Bernanke, Janet Yellen, and today Jay Powell sits in that position. So when our president goes to those meetings, I already mentioned that as a regional executive, I'm bringing information to him that is combined with individuals from across the Southeast. There are 6 of us in total. We all travel to Atlanta for the balance of a week to discuss with him and his team of economists how we see the economy. So the other side of this chart on the left side, if you're looking at it, is the economist's responsibility. So they're back in Atlanta in their offices, crunching numbers, talking about data, somewhat looking in the rearview mirror because the data piece of it is past history. The information the regional executives are collecting is what's going on currently and provides us insight into hopefully where the future of the economy is headed, so we can respond in an appropriate and timely manner. Last week, the Federal Open Market Committee decided to raise interest rates by about a quarter of a point. The range for those interest rates now sits at 1.75 to 2%. That's the target range that will keep those interest rates in until the next meeting, and a meeting rather, that they decide that it is time to do something different. Some of the reasons that went into that decision or in their statement, they have to do with business spending, the employment situation, which is very healthy at the moment, and the consumer and household spending also remaining strong. There's some more walls of words about some of the calculus that went into their thinking, and after this wall of words, I have a technical explanation for you from our economic house of what that looks like when we translate it to monetary policy. So how do we keep it between that 1.75 and 2%? And what is expansionary policy versus contractionary policy look like? So here's a technical explanation of expansionary monetary policy. So after a recession, for example, when we want to encourage businesses to spend, we expand the money supply so that businesses are able to do that. Today, we're in a different mode. We have moved through the expansionary process. We are still in an expansionary process, but we've tapped the brakes of this. We are no longer expanding our balance sheet. In fact, we are contracting our balance sheet, and that's what that looks like. So now I'm going to step you through a three-legged stool of the areas that FOMC thinks about. So what are they doing with the forecast information from the economists? What kind of data are they looking at? And how are they onboarding what the regional executives are telling them businesses are experiencing in the economy? This is one way to look at growth. So 0 on this chart is neutral. All of the colors above 0 are contributing positively to the economy. All of the sections below 0 are drags on the economy. So I will mention that large green section above 0, that's consumer spending. They are the largest contributor to growth in the U.S. economy. But let's look for a minute at the behavior of both businesses and consumers since the recession. So this is a picture. One is business spending or business fixed investment, and one is an example of personal spending or consumption. So we've equalized all of the recovery periods related to every recession back to 1960. So each of those lines represent a recovery period associated with a recession. The current recovery period, so those lines indicate spending by quarter related to one another. So the current recovery period for both that business chart and the consumer chart is that bottom line with the dots on it. So essentially what this tells us is both the consumer and the businesses have changed their behavior since this last recession. They are not spending in a recovery period as they did in previous recoveries. That's neither good nor bad necessarily, but it has implications for how we react both to continuing reactions to a recession and then throughout the recovery period. So the fact that we've had less spending on behalf of businesses and consumers means that it's been a slow recovery. That growth on that GDP chart, part of what moves that growth is business spending. So if you think about when businesses spend, some of the reasons businesses spend is to make their employees that they've now hired back after a recession more productive. Productivity is part of the math equation for increased growth. Without the business spending, we don't have more productive employees, and so growth has been moving forward positively, but at a slower pace than we've been used to in other recovery periods. The housing supply. So we all know that part of the crisis was caused by a crisis around housing. You can see the shaded area there is sales. The green line is inventory. So after the housing crisis, we had a lot of extra inventory. We've worked through that inventory. Sales have recovered, but there are a lot of things that have changed around housing. One of those things is it's harder to qualify to get a mortgage. So that has curtailed sales from where they were leading up to the recession. One of the other things that's changed around building new homes, this is a chart about existing sales, but with new homes, part of what we hear from our contacts is it's a lot more expensive to build a new home today than it was prior to the financial crisis. So that means that not only is it harder to qualify for a home, but those homes cost more money. So there are not as many of those starter level homes being built today. We survey builders and brokers across the Southeast in addition to looking at data, in addition to talking to people. Again, zero is neutral, so when we see these lines from builders and brokers about the traffic they're seeing and the interest in their properties, above zero is a positive comparison from last year. Below zero is a back off of activity from the previous time period. The dollar, the strength of the dollar has an impact on the manufacturing sector. So not only are we looking at things that are happening in our economy, we're looking at what impact the value of the dollar might have on our businesses to export their goods and services to others. And we can see from this chart that as the strength of the dollar pushed through, so that it's cut off, but this chart goes through May of 2018, that there were not as many orders on our manufacturing sides. That has leveled out, and it has leveled out in a way that has been positive for U.S. providers of goods and services. Unemployment's the second leg of the stool. There are three lines on this chart. Ones that you hear, one of them is something you hear on the news. It's the official unemployment rate at 3.8%. We at the Fed are charged with full employment, though, if you remember from one of my first slides, and full employment means that we want the potential U.S. worker to be fully realized. So there are a few other things we take into account that have us looking at a broader rate of unemployment, which is now at 7.6%. That includes people that are part-time but would rather be full-time, and it includes people that are marginally attached, meaning they've been unemployed too long to be counted by the Bureau of Labor and Statistics in the 3.8%. To us, that's an underutilized resource, and if you want a job, we think you should have one. We're charged with full employment, so we look at both measures. The participation rate came down significantly after the financial crisis. The crisis was certainly a driver in that, but also the demographic age of the U.S. population is another significant driver in the participation rate today. And so as baby boomers continue to retire, our economists, through their forecasting, think there will be continued pressure, and this line will actually return to a bit of a downward trend as that continues. So wages, I've described a 3.8 unemployment rate, which is strong by historical measures, but something that happens historically when you have an unemployment rate that low is there's a lot of wage pressure. I'm not hearing about a lot of wage pressure from my contacts, and this chart demonstrates what I am hearing. Usually employers are engaged in raises or merit programs to their staff that range in about the 3% area across Louisiana and the states that I represent. What's interesting to look at, in particular with wages, is that connection to productivity. So remember I said when businesses spend in capital projects, one of the reasons they do that can be to make employees more productive. We haven't seen an uptick in productivity rates. Productivity over the course of this recovery is sitting at about 0.5%. That is low compared to other historical periods, and so wages have not followed along with that. I'm now going to build just what I think is an interesting picture and depiction of what a health check of the employment market looks like for us. So I'm going to populate this screen with a number of items that we look at. They're wrapped around this circle. The innermost part of this circle, think of as 0. The outermost part of this circle, think of as 100%. And think of it as a health check, for example, if you're going to your doctor. So the innermost line that I've laid on there is the bottom of the recession in 2009. The line out from that is blue is the top of the last expansion period in 2007, and the outermost kind of brownish gray orange line is where we are today. The thing to note about wages on this chart is that at the bottom of the recession and at the top of this, or at where we are in this current expansionary period, really haven't moved very far from one another. There's been recovery in those marginally attached and part-time workers I spoke about, but wages are not moving in a manner that we are historically used to seeing employee behavior. Some of the reasons I hear for that are that we can't raise wages because we do not have pricing power. We cannot raise our prices to cover the compensation that we might want to engage in. And this is the third leg of the stool. It gets into inflation. So what I've done is kind of link together for you how some of these variables we study tie together. So business spending, consumer spending, labor, employment, wages, productivity, all of those things can have an impact on inflation. Remember our dual mandate, price stability, that's inflation. The FOMC has decided that 2% is about where they want to be. That does not mean that we want it to stick at 2%. When you hear our chairman or other members of the FOMC talk, they describe a symmetry around 2%, meaning they're comfortable a little below and a little above. And this is three different ways to look at where we are today. The drop-off you see in that blue line, or PCE, personal consumption expenditures, that's the drop in the price of oil. So you can see the impact the price of oil had on inflation. The green line excludes food and energy, not because we don't think it's important, but it's just a way for our economists to take out two measures that are very volatile. Food and energy prices change a lot, so if we want to see what's happening to the core, they take those two things out. We don't ignore it, but it's a way for them to look at it. The trimmed mean PCE was named by the Dallas Fed. They won't let me change the name, but it literally means they trimmed off the high movers and they trimmed off the factors in this series, or the individual prices in this series that moved at a slower pace. Again, another way to look at the middle, what's happening to the core prices. Today, they're all basically moving in the same direction, not overly or underly influenced by any of the things that have been excluded or included in this series. And this means that the FOMC, that committee, is about achieving their target. It's as close as we have been in my career with the Federal Reserve Bank. We don't just take what we see in the inflation index number. We also survey a number of businesses across the country about their expectation for what they are going to see in inflation from vendors that provide services to them. And indeed, that is moving above 2%. So the response I've already talked about of the FOMC. I'll move from that just to give you a real brief look at our balance sheet. Quantitative easing, or QE, as you might have heard it talked about in the news back at the time of the financial crisis, was that baby with the money. We were expanding the money supply through the purchase of treasuries and mortgage-backed securities. Those measures or items sit on our balance sheet today. And at the end of last year, the Federal Open Market Committee decided they were going to stop reinvesting the items that matured on our balance sheet at a very measured pace. So you'll notice that at the very edge of this chart, you can just see the line on this chart that says 4.5 trillion, by the way, is where our balance sheet was sitting. We're now down just below 4.5 trillion. In October of this year, we will top out at 50 billion a month that we will let roll off. So think about that for a minute. It's a $4.5 trillion balance sheet on the asset side, and we are letting roll off, or we're not reinvesting, 50 billion a month. So it's going to take a while before we see an extra line on that chart, is what it means. That is a recap. A few words from our president. Really, I've characterized those here today, but this is a nice place for me to stop and to let you know that everything you've heard from me here today is my opinion, and my opinion alone, not that of our president, the Federal Reserve Bank system, or certainly any member of the FOMC. So with that,
because it's your opinion and not the Fed, what is your opinion of the effect that tariffs will have on the general price level? And how do you see the Fed responding to it with interest rates?
Okay, so the question is about tariffs and how we see the potential impact of tariffs and how the Fed might respond to interest rates. So As the Federal Reserve, it is our responsibility to make sure we are watching what is coming in the economy. That's why I'm out talking to businesses. So the Federal Reserve cannot telegraph what we think is going to happen because it hasn't happened yet. We're going to be looking to businesses to tell us what's going to happen. And so what I'm hearing from my contacts today is there is a lot of concern about potential tariffs, especially in South Louisiana, for any number of reasons. The number of ports that we have, the petrochemical industry, agriculture, just to name a few. That continues as you move across the states that I'm responsible for. There's enough concern where it's moved into a risk that the Federal Reserve is now openly thinking about, and that's how we speak about it. It's a risk in the balance of things that we look at. But until behavior changes, there's not a response that you will see from us from a monetary policy perspective. So once those policies kick in and there's a response from businesses both internationally and nationally, most specifically here in the U.S., so we don't establish monetary policy for the globe, we establish monetary policy for the U.S. So whatever those reactions are, we will be thinking about what implications that has on prices, what implications that has on potential growth for this economy, and responding accordingly.
With the economy changing technology-wise and such, is there any data or demographic that's new to the Fed they've started taking into account that they haven't in the past, say, the past 4 or 5 years?
So we have access to all of the data that everyone in the room has access to. Most of the data series that we use are from government entities. When we want to know something that we don't necessarily see in that data source, or we want to know something more timely, it's in the form of those surveys that I mentioned, and any survey that we conduct at the Federal Reserve Bank of Atlanta is available on our website. So technology has actually enabled us to conduct that in a very immediate type of manner that we didn't have at our fingertips prior to us, I would say over the past 10 years. We've really stepped up our use of those surveys. And so I just showed a few of those today, but we do these for decision makers across the country. We do them not only in real estate, but with small business and some other areas. I have a number of contacts present in the room today who have recently participated in a technology survey for us that we're participating in with other central banks from across the globe to see if we cannot create some data that is globally oriented rather than just domestically. Way in the back.
I've always wanted to ask this question of a Federal Reserve economist, but how do you personally reconcile the fact that we live in a country that primarily bases their economy on free markets and the free exchange of markets to determine a price, yet we control the most important price in the economy, which is the interest rate, by a group of basically bureaucrats. And I'm wondering personally, does that create a conflict for you personally, and how do you reconcile it philosophically?
So it doesn't create a conflict for me for the following reasons. So I mentioned our 12 Reserve Bank presidents. Those individuals are chosen by the boards of directors of those individual corporate entities I mentioned at the beginning of my talk. Those individuals hail from academic institutions, from private business and industry. Some of them are economists, some of them are business people, some of them have worked in the Federal Reserve System for quite some time. In addition to those 12 individuals that sit on that interest rate committee are 7 other individuals at the Board of Governors. Those individuals are appointed by the President, confirmed by Congress. We do not have the full 7 today, but they, when they come on board, also bring a diversity of thought and background to the process. So small banks are represented, industry is represented. There are PhD economists. There are 12 different economic houses within the Federal Reserve System and an economic house at the Board of Governors. So the system is specifically set up to bring in diversity of thought, to represent a broad number of industries and individuals. I mentioned also the boards of directors that we have within the institution, and those boards of directors have a very different role from most of your normal boards. They are selected to participate with the Fed to represent their industry and their region. So we're asking them about the economy in those areas. So all the questions that I described that we're asking individuals as regional executives, we test all of those theories out on our directors. And the meetings, we spend 2 hours once every 6 to 8 weeks with those individuals in the branches. And then a representative from New Orleans travels to Atlanta and represents the New Orleans Gulf Coast region that I described on the Atlanta board. So there's a lot of input, not just from the presidents who are diverse or those governors, but also from industry, business people, community areas, labor's represented, are all through that board of director structure also. So that is my experience with it, and a process I have been attached to in one form or the other across my 27 years, and am happy to stand up here and talk about.
You hear in the media that we have more jobs than we have employees to fill them. Do you think that's going to have any pressure on upward movement of wages?
So do we have more jobs than we have employees to fill them, and what does that mean for wages? Quite frankly, the wage piece is a bit of a head scratcher for our economists. So my job is to represent the views of business, and that's exactly what I do when I travel to Atlanta, as do the other regional executives. And I've told you a very brief synopsis of what we're hearing from business. And the reason wages aren't going up is because there's not enough pricing power on behalf of business. And businesses also are not taking on as much risk as they were during the financial crisis. That's a key piece of why businesses are making much more conservative choices. There are a number of things that make it very complicated to project when that pressure will hit. I also hear from my contacts that it's coming. And when it comes and hits a particular industry, it comes fast and it comes hard. So people aren't generally raising beyond 3%, but if a business is pushed to a place where they can no longer provide their goods and services to their customers, that is the point in time at which they will raise wages. And that's the point in time the conversations I have with those businesses change to things like, I raised across the board 10% for this skill level in this geography in this plant. It is not I raised 10% across the entire footprint. It is very specific because the data we have today allows employers to very finely pinpoint where it is they want to invest that money. Technology has also eliminated a lot of positions for employers, allowed them to automate rather than fill some of those jobs. My contacts will, even sometimes if they don't want to take that route, they will, because they can't find employees to fill the jobs. Something else that we hear from contacts has to do with the retirement of baby boomers and the knowledge and the experience that we're losing from the workforce. So that has a bit of a dampening effect on wages. It also has an impact on productivity because you're trying to train a new workforce to step in for that experience. So it's a bit complicated. There is not a clear line of sight on when it is going to be enough volume of those stories that I mentioned to move it, but contacts assure me it's coming. That's the best explanation I can give to you. I don't have a crystal ball to tell you when. To the question of at what point is there so much pressure that the fact that we don't have enough workers to fill job openings is a problem, I don't know the answer to that either. I do know we're about 20 years behind the traditional way to create a worker, and so we're not going to change the biology at work there. And so here we are. And so employers will have decisions to make. Oh, wait a minute, I hear it. Go ahead.
It said that housing construction costs have gone up, but wages haven't. Did wages go up in home construction?
Yes. Yes. So when I say wages haven't, that's a national average. In the case of construction, there is a lot of wage pressure in construction. There is a lot of wage pressure in healthcare. There's a lot of wage pressure in IT. Again, it just hasn't been enough to push that whole number forward.
Why is that? What's causing that?
What's causing the wage pressure in those industries? Well, somebody said supply and demand, and that's just it. As we've come out of the financial crisis, so if you think about the financial crisis, there were a lot of people engaged in construction leading up to the housing crisis. Those individuals had to find other ways to be employed after the crisis because it wasn't in construction. So we have an environment where a lot of those individuals found other things to be employed in. Some of those individuals have retired. Some of those individuals no longer live in this country. So we don't have the supply of skilled construction workers that we used to. So as a result, yes, wages, we hear from our contacts, have gone up extremely around construction, and it's a piece of the reason construction is more expensive. It's not the sole reason. So we've already seen an impact. Somebody asked about tariffs earlier. We've already seen an impact to the price of steel and aluminum on construction. We've already seen an impact from the changes not only to the ability to qualify for a mortgage, but locations. So city and state and county parish governments in some cases have also changed the regulations around where you can build and how you can build and why you can build. So it's become more expensive for all of those reasons.
What do you feel the impact of the differential spread between interest rates in the United States and those countries that have negative or much lower interest rates that are raising them yet is going to have on the Fed interest rates?
So I mentioned earlier that we establish monetary policy for the United States, but we keep an eye on what is happening in the global economy. So some of the economies that you mentioned before, when you get into the data, part of how we assess what that impact might be is we look at where is the U.S. economy tied to the industries within that particular country. And the balance of risk for those countries for the U.S. as a whole is not incredibly significant at this point in time. Let me do one more?
Yeah, one.
One more.
Thanks, I got an under the wire there. I've always wondered about this. When you look on a dollar bill, for example, you see a Federal Reserve note on the dollar bill, and then it has like the Federal Reserve Bank of Atlanta or some other number. What is the relationship between the U.S. Mint that prints money, and is there an allotment that each bank has?
So they're Federal Reserve notes. That's why you see the Federal Reserve on that note. The 12 districts are represented on those notes. There's an accounting process I'm not going to get into about how that allotment works. It has to do with the balances on each Federal Reserve Bank's books and that asset side of, and liability actually side of the balance sheet. So the Bureau of Engraving and Printing, which is the Department of the Treasury, is who prints U.S. currency. The Federal Reserve Bank system every year orders the amount of money we think we need to physically pay out of our doors. We're the only people that can issue currency. It's why our name is on it. We purchase that money from the Bureau of Engraving and Printing for the printing cost. And so that's part of how a central bank creates money. So I had a tongue-in-cheek explanation of it earlier, but from the printing side, if you think about it, if it costs, say, a cent or two to print a note, we purchase it for that cent or two and then issue that note at 100 cents. So that is how a central bank creates currency for the country that it's a central bank of, or how ours does anyway. The Mint, actually, we have a different relationship with. The Mint, we purchase coins from them at face value. And that's just how it was set up by law. Thank you.
Support provided by Walters, Papillon, Thomas Cullens, LLC, specializing in business litigation and personal injury cases for over 40 years.